Hello everyone, welcome to my channel. Today we are diving into a topic that sits at the heart of inclusive growth and rural development, that is microfinance delivery models in India. If you ever wondered how people in remote villages access credit without any collateral, or how financial institutions manage risks while still reaching under-reserved populations, this discussion will give you a clear picture of it. Microfinance is not just about giving small loans, it's about creating opportunities, enabling entrepreneurship, supporting the livelihoods, and most importantly, empowering communities that have historically been excluded from formal banking systems. In India, where a large portion of the population still lives in rural and semi-urban areas, traditional banking alone cannot meet the diverse needs of people. And that's why different delivery models have evolved over time, each designed to solve specific challenges like accessibility, affordability, and risk management as well. In this presentation, we will explore five major models that are widely used across the country. We'll understand how they work, why they exist, their strengths, their limitations, and what they mean for the future of financial inclusion. Whether you are a student or a professional, policymaker, or just someone who is interested in how the economy works at the grassroots level, this video will help you understand the real mechanism behind rural credit delivery. So let's begin. This journey into the world of microfinance and discover how innovative financial structures actually are and how they are transforming lives across India. So moving forward, to understand microfinance, we must first need to understand the problem it tries to solve. In many rural areas, people face major barriers when trying to access formal credit. Banks often require collateral, documentation, and credit history, things that many low income category people or households simply do not have. Because of this, people often rely on informal money lenders who charge extremely high interest, trapping borrowers into the cycle of debt. Microfinance emerged as a solution to bridge this gap. This provides small loans, savings options, and financial services tailored to the people with limited resources. But delivering these services in rural areas is not easy. Institutions must deal with high operational costs, dispersed population, and higher perceived risk. Over time, different models have evolved to tackle these challenges, and in many unique ways. Some models focus on building trust through community groups, others use partnership to scale quickly, and some rely on technology to reach remote regions. In this analysis, we examine five major delivery models that represent different approaches to the financial inclusion. Each model serves as a specific segment of borrowers while balancing social impact with financial stability. As we go through each model, uh, think about how innovation in finance can create real social change. Because ultimately, microfinance is not just about money, it's about the opportunity, dignity, and empowerment as well. Moving forward, the first point we'll discuss is SHG, Self Help Group Bank Linkage Model. Let's start with one of the most successful and widely recognized models, the self-help group bank lineage model. This model built on a simple yet powerful idea, which is people are more reliable borrowers when they support and monitor each other. In this structure, small groups, usually women, come together and start a saving regularly, regular period of time. Over time, these savings create a shared fund which builds financial discipline and trust within the group. After demonstrating consistent saving behaviors, the group becomes eligible to access bank loans. Because the bank sees a proven track record of discipline and peer accountability, it considers the group as less risky. One of the biggest strengths of this model is its extremely low default rate. social cohesion, and peer monitoring, encouraging members to rely to repay on time because their reputation within the group matters. Beyond financial benefits, this model has strong social impact. It empowers women, improves financial literacy, and strengthens community bonds. Many members use loans to start small businesses, invest in agriculture, or manage household emergencies. However, the model does have some limitations. Loan sizes are often small, which may not meet the growing business. Also, scaling this model requires strong group of management and support system. Overall, the SHG model shows how social capital can be just as powerful as a financial capital in reducing risk and promoting inclusion. The next part here is the MFI bank partnership model. In this model, bank provides bulk loans to microfinance institutions or MFIs, which then distribute the loans to individual borrowers or small groups. MFIs specialize in last mile delivery, meaning they have strong local networks and understand borrower needs better. This partnership allows banks to extend outreach without setting up new branches. While MFIs gain access to capital, the result is rapid credit expansion, especially in the underreserved regions. However, this model also brings risk because MFIs operate at a scale. There is a possibility of multiple borrowings, where borrowers take loans from several institutions simultaneously. High interest rates and aggressive recovery practices have also raised concerns in the past. Despite these risks, the model plays a crucial role in expanding credit access quickly. With proper regulations and monitoring, it can balance efficiency with borrower protection. So, moving forward, now let's talk about the business correspondent model, which brings banking directly to people's doorsteps. In remote areas where setting up a bank branch is not economically viable, bank appoint local agents called business correspondents. These agents use digital devices to provide basic banking services like deposits, withdrawals, account opening, and government benefit transfers. This model has revolutionized financial inclusion by making banking accessible, even in the tribal and remote villages. It reduces travel time and cost for customers while helping banks expand reach at lower cost. However, the model faces some challenges as well, like low transaction volumes, which can affect agents' income, and connectivity issues in remote regions as well. Still, the BC model, correspondent model, demonstrates how technology can transform financial service delivery and make inclusion more practical and scalable. The next model we'll talk about is the joint liability group model focuses specifically on farmers who lack land, titles or collateral. In this structure, small groups of farmers come together and jointly guarantee each other's loans. Each member receives an individual loan, but the group shares responsibility for repayment. This model works well in agriculture because income is seasonal and unpredictable. Peer support helps manage risk and encourages the timely repayment as well. However, the same peer pressure that promotes discipline can also create social stress as well. If one member defaults, uh, despite this, the model remains highly effective in providing credit access to the farmers who would otherwise be excluded from the formal finances. Moving forward, the linkage program involves NGO acting as facilitators between communities and banks. NGOs help form groups, provide financial literacy, uh, training and support bookkeeping. Once groups are ready, they are linked to banks for credit access. This model strengthens community institution and improves financial awareness. It also reduces dependence on informal lenders and builds a strong repayment culture. The success of this model depends heavily on coordination among stakeholders and the capacity of NGOs to provide ongoing support. Overall, it represents a holistic approach that combines social development and financial inclusion. Now, when we compare all five models, we see that each serves different purpose. The SHG model focuses on stability and empowerment. The MFI model emphasizes scale and speed. The BC model improves uh, outreach. The JLG model supports the agricultural borrowers, and the linkage program provides or promotes the holistic development. No single model is perfect. Each has their strengths as well as their weaknesses depending on the context. This comparison shows that a diversity in delivery approaches is necessary to meet the varied needs of the rural population. Now, if we move forward to the key insights, looking at these models together, several important insights emerges. First, a hybrid approach works the best. Combining social models with institutional models creates a more resilient system. The second, social capital plays a major role in reducing credit risk. Third, the technology improves the efficiency to reduce the cost. And finally, strong regulation is essential to protect the borrower and ensure ethical lendings in the practices. These insights are crucial for policymakers and financial institutions designing future inclusion and strategies. Now, if we talk about the key takeaways that we can take from here to and the conclusion part. So to conclude, microfinance is a powerful tool for rural development and poverty. Each delivery model plays unique role in expanding financial access and supporting livelihoods. The future lies in integrating these models, leveraging technology, strengthening the governance to create more inclusive financial ecosystem. As we move forward, the goal should not just be expanding credit, but ensuring that financial services truly improve people's lives. So that's it, and thank you for watching. And I hope this session helped you understand how microfinance delivery models works and why do they matter. Thank you.